Okay, so monetary policy, let's get started. So there are a few topics under monetary policy we'll be talking about. We've got interest rates, expansionary versus contractionary monetary policy, why we want monetary policy, how interest rates would affect exchange rates, and of course advantages, disadvantages, and how to evaluate monetary policy. Yeah. Okay, so to begin, let's just have a look at what interest rates are. So interest rates are basically the amount of money we need to pay when we borrow money from the bank. Yeah. So it's not just the original amount that we're borrowing that we have to pay, but also an additional cost of borrowing called interest. Yeah. So that is what we call interest rates. However, we can also look at the other side of the coin. But before that, let me just write a few numbers on the screen so you get what I mean. So let's say if you borrow like $100 from the bank and interest rate is at 5%, then in total you need to return $105. So there's like an additional cost for you to borrow money from the bank. Otherwise, how can the bank make money? Yeah. But yeah, again, if we think about it on the flip side, if you're lending someone money, so if you lend someone $100, then you would have earned more money from the person that is borrowing from you. So as a result, interest rates can be like a double-edged sword. You can be earning money, or you can be paying a higher interest when you're borrowing. So you can see in this case, on the next slide, if you've got like, I don't know, $80 or something, and 100 years later, you would get more money. I'm not sure how much there is, like 800, something like that. And that is the power of interest. So, I want to talk a little bit about credit cards actually. I'm not sure if you guys have a credit card yet because you are students, so you probably won't be approved to get a credit card, but you might get one from your mom or from your dad, something like that. But I just want to talk about the interest rates on credit cards. Yeah. So we can see for this British Airways Amex credit card, we need to pay 74% interest. So what does that actually mean? It means that if you borrow £100 or if you spend £100 on that card and you don't actually return it, next year you need to pay back £174. Yeah. So that's almost like double the amount that you borrowed from the credit card. So make sure you don't max out your credit cards and just pay the minimum amount. Otherwise, you're going to be paying that debt forever. Same for this one. So especially these cards where they say that they're very prestigious or very elitist and things like that, but they actually need you to pay like 60% interest each year. So yeah, just be careful of that. Now let's look a bit about how interest rates actually affects us. So depending on what type of person you are, interest rates would affect you differently. It might be beneficial or it might be detrimental. And if you are a saver, so if you guys have a savings account with HSBC or like Barclays, for example, then actually you don't earn a lot of interest, even though the bank does pay you interest. So maybe if you deposit like, I don't know, 10 grand or something, then if that's the case, you might only get like £1 a year. So like the interest is like 0.01% or something like that. So it's kind of ridiculous. And which is why a lot of people don't want to save their money in savings accounts. So we can see from this comic, this guy who is saving money from a savings account needs to talk to a psychologist because the interest rates from saving accounts are just too low. So you aren't earning much money just by putting the money with your bank. So that's kind of how interest rates affect savers. Similar to savers, interest rates also affect pensioners. So in general, if you've got higher interest rates, pensioners tend to benefit from that because pensioners receive some money each month from the government. And in a sense, pensioners are taking money from like a big pot of their savings. So let's say if they've saved up $1,000, then maybe each month they may take like $50 or something. And interest rates are good for pensioners because if interest rates are high, they should be able to increase their total amount of money that they have. First-time home buyers, generally, if you're trying to buy a home, you would want to get a mortgage. And what a mortgage is when you get a mortgage, you are basically borrowing money from the bank. So here's the bank. I'm not sure how to draw a bank, but there we go. So you take money from the bank. And of course, if you borrow money from the bank in order to afford a house, then you need to pay the bank some interest. So if interest rates are actually low, then you would be more motivated to buy a home because you would pay less in terms of your cost of borrowing. And of course, interest rates would also affect companies. So if you're a company, and a lot of companies, in order to expand their businesses, they borrow from their banks and they borrow through their business accounts. So if you're trying to expand your business and borrow money from the bank, of course you want the interest rate to be low. So you would pay back the bank less money. And similarly, if the interest rate is low, then that means you might be able to generate a greater reward from your business projects, depending on the level of profits you might get from the amount of money you invested. And then property owners. So property owners tend to be on a mortgage as well. So that means that they have borrowed money from the bank in the past in order to buy the property, but they still need to pay back money every month to the bank. So if that's the case, and if you have something called like a variable mortgage, so a variable mortgage is that the interest rate you set with the bank tends to move with the interest rate in the economy. So as a result, if you've got a variable mortgage, you would want the interest rate to be low because again, you'll be paying back less money to the bank. So you can see here, another comic. So the wife is asking the husband, "How can you call me unemotional? You've seen me cry over interest rates." So most likely, if interest rates increase, then the husband probably needs to pay more money back to the bank. So that's why the husband might be crying over the interest rates, since they might have borrowed money in order to buy the house that they're living in. And yeah, so that's kind of like how interest rates might actually affect different types of people in society. And as you can see, by changing an interest rate, increasing it or decreasing it, it would actually create winners and losers within society. That means that, you might lose or win votes. But fortunately, interest rates aren't actually determined aren't determined politically. Yeah, so they're determined by the Monetary Policy Committee, which we will discuss later. So it's dependent on the central bank by a group of economists rather than politicians. So we've talked a lot about interest rates, but now let's get into monetary policy. So what monetary policy does is it uses interest rates as a tool in order to affect our economy. So again, it is a demand side policy because it aims to change the level of aggregate demand in the economy by increasing or decreasing interest rates. Monetary policy will also involve money supply as well, but we will kind of look into that a bit later. But in general, we can assume if the government increases the interest rates, or if the MPC, Monetary Policy Committee, increases interest rates, then this would contract the economy. And if it decreases interest rates, it would expand the economy. So again, we've got a contractionary policy and an expansionary policy, similar to the fiscal policy. So let's try to take advantage of interest rates. Let's assume that you can't be Boris Johnson or Theresa May because they don't determine the interest rates. Okay, let's say if you're Ben Bernanke, something like that. Yeah, So that's like the US central bank. I think he's bald, if I remember correctly. But anyway, so if the economy is doing well, then you, as a central bank, would want to increase the interest rate if the economy is doing well. Because if you increase the interest rate, the cost to borrow will be more expensive, and as a result, people are going to borrow less money for consumption, so less people would get a mortgage, and also businesses would also borrow less money because it's more expensive to do so from banks. Therefore, the levels of investment and consumption would decrease in the economy, and because of that, it would decrease the overall level of demand in the economy as well, which would shrink our economy and help to tackle inflation. So, in most cases, we want to increase the interest rates in order to help control the price level in our economy. And as we can see in the diagram, when we've got two aggregate demand curves, if you decrease the aggregate demand, we can see that the GDP of our economy actually would decrease and shrink. So we're going from point A to point B. And essentially, we would see that the price level of goods and services in the economy should decrease as well, if holding everything constant, right? Because we're always holding everything constant in economics. Of course, this would be called contractionary monetary policy because we're kind of shrinking the economy when we increase the interest rates. So, yeah. And if we think about this the opposite way, of course, it would be to decrease the interest rates. So during times of COVID, like now, as you will see later, our interest rates are ridiculously low, nearly like non-existent. And they're doing this in order to stimulate the economy. So if interest rates are very, very low, like 0.1%, then this means that companies and individuals are more likely to borrow money. And when they get more money from their banks by borrowing, they would be able to spend their money on investments and consumption, and therefore, again, this raises the level of demand for goods and services in the economy, which would actually accelerate the economy, causing economic growth from Y to Y1 in the diagram, and this would also increase the price level because now that there are more demand for goods and services, you would be willing to pay a higher price in order to secure those goods and services. And that would be called expansionary monetary policy. So very similar to fiscal policy, because they're both demand side policies. When you're in a boom or when the economy is doing well, we want to contract the economy. And when the economy is doing badly, so if we're in a recession, then we'll want to expand the economy. Okay. So again, any questions, just pop in the chat. So beware the banksters. The base interest rates are actually set by what we call the Monetary Policy Committee. Yeah. So Monetary Policy Committee is these gentlemen, so they might have changed by now. This is a very old picture, and of course in the UK this is done through the Bank of England. So they operate separately from political pressures, even though you often see Trump telling the central bank to increase their interest rates. Actually to decrease the interest rates, so it helps with the election and helps stimulate the economy, even though it might not be appropriate. But yeah, so they are free in a sense to decide what the interest rate should be, and they would vote to determine what the interest rate should be. So if the majority of them thinks that they should increase the rates, then the rates would be increased or decreased. And another function of the central bank or the Bank of England is to lend money to high street banks. So as you may have known, in the Great Recession of 2009, so Great Recession, actually what happened was we need to bail out of these banks, right? The reason being is because they're collapsing, and when the banks collapse, most likely there might be like a negative externality and a ripple effect on the economy, which would kind of basically destroy our economy, and that's not very good. But as you can see from this cartoon, there are some disagreements as to whether we should bail out the banks using money from taxpayers, because after all, it is partially the bank's fault because of toxic assets and the mortgages and investments that they sold misleadingly, which caused the collapse of the financial system. So you can see from this cartoon here that they are too big to fail. And of course, they are thanking you for the bailout and actually taking money from the taxpayers. Okay. And to make things even more complicated, banks tend to lend to each other, and that is called the interbank lending. Yeah. So the reason that banks need to lend to each other, and also the central bank needs to lend to high street banks. So the central bank is the Bank of England here. So central bank, and then high street banks are like the banks that we know from the high street, like HSBC. So the reason that the central bank lends to high street banks and the banks lend to each other is because of liquidity. So every day you might like withdraw money from the bank, and every day people would deposit money from the bank. But sometimes you might withdraw more than you deposit, like in total, for the general public. Therefore, in order to kind of like make up for the withdrawals, the banks that day would need to kind of borrow money from the central bank or from other banks in order to fill out the gap. So let's say if you, in total, today, $500,000 was withdrawn. But then perhaps the bank only had like $1,000. So that means the bank needs to borrow, what, $499K from other banks, or like from the central bank, in order to have enough money for the withdrawals from the public and to ensure that they stay liquid and have enough cash, basically, for their daily operations. So it can get confusing very quickly if you look into this, but you should if it is something of interest. Okay, so recently, I'm sure you guys have heard there's like a ridiculous decrease in interest rates. So you can see from The Guardian that the UK might actually implement a negative interest rate. So a negative interest rate is basically, instead of the bank paying you money because you're saving money with the bank would actually charge you money when you're saving with the bank. So that's kind of counterintuitive, right? But the only reason this works is because you don't want to carry loads of cash. Because supposedly, if the bank is charging you like 1% each year to save money with them, then everyone rationally should take out all of their money from the bank and just hide it under their mattresses, because they wouldn't want to pay that 1% interest. But because of the inconvenience of this, negative interest rate would actually still be able to keep money with the banks if it is low enough. Since we don't want to carry cash around and like act like a gangster and like, let people know that you're rich. That's not a very wise thing to know. So negative interest rates should help to promote the level of consumption in the economy as well, because if you see the amount of savings that you have decreasing each year by 1%, then as a result, you want to spend your money as quickly as possible, right? Because each year the value of your money is decreasing. So you want to spend more right now and kind of get more value out of your money. And of course, we've got another comic here. You can see that this is probably Theresa May or something, ready for blast off, but then like the interest rate is the other way around. So it's like negative interest rates. And so during the coronavirus pandemic and recession, most countries like the US are trying to decrease their interest rates as much as possible, right? So that by doing so, they would be able to stimulate the economy, like we previously discussed. And now let's just look at how interest rates would help achieve the different macroeconomic objectives. So we've discussed about economic growth. So if we contract interest rates, or if we use a contractionary monetary policy, then this would help control inflation. And then if we want economic growth, then we would want to expand the economy, right? So we would want to decrease the interest rates. So expand. So we want to decrease the interest rates. Yeah. Of course, the other macroeconomic objectives would be to reduce unemployment, right? So if we want to reduce unemployment, since unemployment is linked with economic growth, then we want to decrease the interest rate. So whenever the economy grows, unemployment should fall, because since we're producing more goods and services, what happens is that the firms would hire more people, and therefore the unemployment rate would decrease. And then finally, to help the government budget. How can we help the government budget using interest rates? Of course, we would want to expand the economy as well, because if the economy expands and GDP increases, then the government will be able to increase their tax base. So they will be able to tax us even more. And then, of course, it would make them richer and it would help with the government budget. Okay. Oh, actually, we're actually doing this very quickly today. And so now we're already at evaluating monetary policy. So how effective can monetary policy be? Well, again, like all economists would tell you, it depends, right? It depends on lots of different factors. For example, business and investment confidence. So during times of COVID, for restaurants and hotels, even though if you decrease the interest rates to like 0% or something like that, they might still not want to expand their business. Let's say if you're like an Italian restaurant, I'm not sure why I said Italian, but mamma mia. If you're in an Italian restaurant, then you probably don't want to expand your restaurant chain or your restaurant business in this climate, right? Because nobody is going to be your customer if we're going into lockdown again, which is likely for the UK. So therefore, even if the interest rate is very, very low, it does not mean that it would always help increase the level of investment in the economy. And simply because the level of confidence of businesses is just too low in terms of their future expectations. So as a result, monetary policy might not always work, or a decrease in interest rate to stimulate the economy might not always work in a recession. And then we want to look at the willingness to lend of banks. So in general, banks tend to be, they want to save their own skin during a recession. So I was just about to say save their own something else, but okay, let's avoid that. So they want to save their own skin during the recession. So as a result, they might not actually lend money or credit to consumers and businesses, even though the interest rate is very low and even though the government wants them to lend. So as you can see in this picture, when the banks or the high street banks like HSBC are dealing with the reserve or central bank, they're like having a leveled playing field. But whereas when the high street banks actually interact with actual customers like you and me, they've got a lot more power over us, and therefore they can decide whether to lend to us or not, or just to keep money in the bank so that they would be safer and less likely to go bankrupt or fail. And finally, actually not finally, but again, one of the points would be the size of the rate change. So the interest rates of the UK had been very low in the past decade. It was around 0.5% for the last 10 years since the Great Recession, which is kind of crazy. And because of that, since the rate is very low already, if we decrease it even further, say to 0.1%, the impact is very, very low. So we can see the size of the rate change is not sufficient to actually stimulate demand in the economy, if that's the case. So therefore, one of the opportunity costs or the problems of using monetary policy is that it might affect your future ability to decrease the interest rate. So Prachi asks, what's the percentage of the interest rate currently in the UK now after COVID? So I think it's 0.1% at the moment, but we will have to check. And also they're considering to decrease it even further to get like negative interest rates. So by that time, either you might want to spend your money very quickly, or you might want to change your currency into another type of money, or save it somewhere else so that you don't pay the bank money. Okay. So the effectiveness will also depend on these things, like the multiplier effect and the time lag. So the multiplier effect, we would kind of cover this in a separate lesson, but what it's mainly about is, again, if the business decides to expand and hire more staff, then it would create jobs, and as a result, new workers will be able to receive an income, which would kind of further buy other goods and services, and then creating even more jobs. So that's kind of like the multiplier effect in the economy. If the multiplier effect is big and a lot of people are like spending most of what they earn, then as a result, the stimulation in the economy by the monetary policy would be more effective. And of course, vice versa as well. So if the multiplier effect is relatively weak, most people are just saving money during a recession, which is usually the case since they want to feel comfortable with their finances, then the multiplier effect is likely to be much weaker during a recession, and which would make monetary policy less effective. And we've also got the time lag as well. So the time lag is always a very good evaluation point for within exams, and also to consider. So in general, even if the government does decide to decrease interest rates to stimulate the economy, it might take up to 3 months or like even 2 years before there is an actual impact on consumers and businesses. So that's kind of like what research has shown us so far. We want to decide what type of monetary policy to use depending on the business cycle or the economic cycle. So like we discussed, we want to do it during times of the peak. So we want to have high interest rates when the economy is overheated to control inflation, such that it goes more like this. So increase interest rates, and then like when there's a recession, we want to decrease the interest rates to stimulate the economy. So that it kind of levels out the economic growth that we can achieve. And then if the interest rates is used to combat inflation, we would want to make sure the level of inflation is kind of in line. Yeah. So, and we want to know like the cost of the inflation as well. So if the inflation is caused by an increase in oil prices, for example, because the cost of raw materials are rising, then as a result, it's not really due to the level of demand in the economy, it's due to the level of supply. So if that's the case, then the monetary policy won't be as effective. Yeah. Oh, hi Zach, thanks for following and joining us. So where was I? Yes. So we want to know the cost of inflation if we're using monetary policy to control the level of inflation. So say if we want to increase the interest rates to decrease the level of inflation, then we want to make sure that the inflation is caused by a too high level of demand in the economy rather than the supply, especially when oil or other raw materials are too expensive. Okay, so here from this graph, we can see that we've got interest rates and exchange rates. Yeah. And we can see kind of like the relationship between the two. So we've got the exchange rate or the value of the pound here. So you can see as the value of the pound goes up, then the interest rates, which is the UK base rate, is also kind of going up. So there's kind of like a positive correlation or relationship between the two. Who am I teaching? Good question. I'm teaching A-level and IB and you, hopefully. And also occasionally we've got like a few students that pop in as well. So usually after the stream I'll just put this video on YouTube and on the channel, and as a result my students will be able to watch them. I also do some private tutoring for those that are studying economics at high school, just pretty much to give them knowledge in the exams, but also like to give anyone that is interested in economics a basic introduction into the subject. But yeah, so if we go back to interest rates and exchange rates, we can see that they would actually affect each other. So in general, when interest rates increase, exchange rates or the value of our currency would also increase. And that's because when the interest rates increase, this means that you would earn more money by saving British pounds in UK banks. And as a result, there would be more investors or speculators trying to save UK pounds in British banks. So they would buy more pounds, thus increasing the value of British pound and the value of the currency. So if you are a day trader or if you are a currency trader, then you would want to pay attention to interest rates, and especially if you're trading the British pound or like USD and all that. Yeah. So that's kind of like one of the ways to explain the relationship between the two rates. And of course, when the value of the currency changes, it's going to affect the level of imports and exports in our country. So if the British pound is becoming very expensive, then as a result, our exports will become more expensive. So if you imagine we've got like British tea bags, so I'm trying to draw like a tea bag, something like that. If we export these British tea bags at like £1 to the US, which might be like 1.5 US dollars originally, then that's fine, right? But if British pounds becomes more valuable, maybe one British pound is now 2 US dollars, then that means our tea bags, which we're exporting, are becoming more expensive. Therefore, you can see how an increase in the value of our currency, British pound, would actually cause our exports to be more expensive. And it's the same for the other way around as well. If we're importing like Cheetos from the US, then we want the value of the pound to be more expensive or to be higher value. So as a result, then Cheetos would be less expensive and would be cheaper to import into the UK. So we can see here that actually if we change the interest rates, it would affect the exchange rate and eventually the amount of imports and exports that we actually carry out within the country. So whenever the MPC or the central bank carries out an interest rate change, we would want to be aware of that, and they will need to take that into consideration. So earlier in the lesson, we discussed a bit about the likelihood of negative interest rates in the near future, which means that we will need to pay banks for them to keep our money, and we will need to pay interest to banks instead of the banks paying us, which is kind of ridiculous. But whenever the press or the media mentions something like this, about the government policy, you can see the value of the British pound would immediately drop when we've got negative rates. Because if there are negative rates and we need to pay banks money in order to store or to save cash, then as a result, everyone is just going to sell their pounds and they're going to save money elsewhere. So the value of the pound in the markets will decrease. But whereas if the interest rates increase, then everyone will want to save their money in pounds because they'll be able to get a higher interest from their savings in their savings account. And of course, another alternative, if we don't want to save in pounds, would be Bitcoin or other electronic currencies. Yeah. So not electronic currencies, but more like other cryptocurrencies. So this would kind of help us save money in a sense, but also it would help us avoid the negative interest rates if they're really charging us to save our money with banks. So cryptocurrencies. There we go. Crypto, not krypton. Okay, cool. So if you're interested, you might want to change your money into Bitcoin. But be careful, it's very easy to lose Bitcoin as well. Okay, so and now we've talked a lot about interest rates, but another way to implement monetary policy would be through money supply. Yeah, so money supply. So there are a few ways to change the money supply in the economy. The government can print money that would increase the money supply. So if they print lots of cash, or if they do quantitative easing, which is a fancy term which economists use, which is actually quite complicated as well. But let's go into the basics of that. So if the central bank or if our government prints electronic money in order to buy assets and investment vehicles from financial institutions, that would be what we call quantitative easing. And the reason why the government would want to do that is because if the Bank of England creates the new money and actually buys the financial assets that the banks hold, like bonds and stocks, then the banks would of course have more money and more liquidity, and therefore the banks would be able to kind of lend more money to individuals and businesses because they now have more cash since they've sold their financial instruments to the government. Yeah. And because their financial condition has improved, then supposedly individuals and businesses will be able to borrow easier from banks, and as a result, this would help stimulate the economy again, because more borrowing means more investment and also more consumption. So this is kind of like the simple version of quantitative easing. Government prints money, uses money to buy stuff from the banks got more money, and now they'll be able to lend more to us, individuals, the small people. However, of course, there's also a more complicated version of that, which involves interest rates and yields. So again, similarly, in this version, Bank of England would actually print money electronically, and then the money is used to buy bonds and other financial investments from banks and other financial institutions. But one thing to know, the complication here is that when you actually spend money to buy government bonds, this would actually increase the price of the bonds, right? Simply due to demand and supply. So since the government decides to buy money to buy bonds, or to buy government bonds usually, then the bonds will become more expensive. So let's say if originally the bond is $100 and now the government is buying more of the bond, it might worth $120. So whenever the value of bonds go up, the interest rate on the bond would decrease. So what I mean by that is, if you have a bond, each year the bond would pay you an amount of interest, because having bonds is basically the same as saying that you're lending money to the government. So the government will kind of pay you an interest every year if you own a bond. So if you have like $10 of interest from the government since you own bonds, and the price of the bond changes from 100 to 120, this means the rate of interest you're getting from the bond has decreased. So you can see in example A, or bond A, you would still have a 10% interest. Whereas in bond B, after the central bank has bought all of these government bonds and the bond price has increased, the yield, or the interest in terms of percentage you get from the same bond that you own would actually decrease. So $10 out of 120, how much is that? That's like 5 over 60, 1 over 12, right? So it's like 0.09, like 8 to 9%, something like that. So the interest rate would be smaller. And of course, whenever the interest rate is lower, this would stimulate the economy, because again, a lot of other types of borrowing, or the rate of the interest on other types of borrowing, would be dependent on the interest rate of the bond. So as a result, because it's now cheaper to borrow from the lower interest rates from bonds and other financial institutions, therefore we would be able to stimulate the economy and increase the level of borrowing and the level of money supply in the economy. So I guess the main point to remember about money supply and monetary policy is that whenever money supply increases, then it should be easier for you to get credit. And therefore, the interest rate, or the cost of getting credit, or the cost of borrowing would be lower, since money is more abundant in the economy, as the government has printed more of it. And therefore, it would stimulate the economy, because it's easier to borrow money, and therefore you can use the money you borrowed for consumption or investment. Okay, so before we end this part, I just want to quickly show you this idea of helicopter money. So I think Trump kind of suggested it earlier in the year, in March, about helicopter money. And the idea is basically just get into a helicopter and just throw money at the public. And another way that they can do that is just to give like $2,000 to each American, right? Or to each person in the country. So it's quite similar to quantitative easing, because helicopter money actually increases, again, the money supply within the economy. And as a result, you can see if everyone's got more money in their bank accounts, of course, they will be able to consume more goods and services, again, raising the level of demand in the economy, and therefore this would stimulate the economy and increase production, consumption, and GDP. So this actually happened in Hong Kong, where the government has already paid everyone 10 grand. But actually 10 grand in pounds terms is just 1 grand, yeah. So if everyone is 1 grand richer, then they'll be able to buy goods and services. But of course, the problem with that is it might lead to inflation, right? Because if everyone is $1,000 richer, that means things are most likely to cost more, because the value of your money, since everyone is now richer, would be lower. So as a result, monetary policy, especially through the increase of money supply, might lead to inflation, which is kind of like one of the disadvantages of monetary policy. So that's kind of something that we need to bear in mind.